All right, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, June 11th, 2020. What we'll do is start out with the major equity indexes. Time permitting, I'll roll into just touch on the euro, the dollar, gold and silver, and treasury bonds, the risk-off assets we've been tracking as well, because that kind of plays into what the market's going to do or is doing. And if I can't get to that, I will say that we had a pretty solid breakout on the dollar today. So again, I just want to mention that, and time permitting, I'll get to it. Otherwise, I'll cover that in another video. All right, first things first. So we had the sell signals today. They were that's about as impulsive as you get. That's a 5.74% drop. The gap itself was impulsive, and as I said this morning, where we gapped to was pretty telling, because had we gapped down to, say, the about 313, 381 or so, well, that's a gap that I would have hesitated on shorting, because it would have been a gap that would have been down to support where the buyers may step in. That's I'm referring to the top of the gap right there, the bottom of the gap right there. And so we didn't. We gapped below the gap. Yeah, I meant to say that. Gapped below the gap, this gap here. And so now what that does is it does a couple things. Number one, it put us below support, which is now or became resistance at that time. Remember, support once broken becomes resistance. So any back test, and even if we were to get a back test now, that would be still a significant level. And depending on what the intraday charts look like, maybe an objective short entry if we get there. And then, of course, we gap below the trend line and well below it, and we close solidly below it. So, not that this guarantees it plays out, but on a scale 1 to 10, for a sell signal, the sell signal we were looking for, a gap down to put in the island cluster top and a gap below the trend line, that's 10. It really doesn't get much better than that. And, as I said before, that island cluster tops, especially after an extended uptrend, are, as the name implies, a topping pattern, and can often, denote or signal a major trend change. Meaning this could just be the start of a lot more to come. We've had quite a few highlighted bearish engulfing candles that look like they were confirmed and didn't play out. So, you have to take it with a bit of skepticism. The rally's been very strong, and more importantly, the Fed has come in as they never have before in history to inject liquidity and support the market. So here's the thing: I can sit here all day long and guess, how much more of an impact that's going to have or not. At the end of the day, if I stop trading and believing in the same things that have worked for years, and they don't work 100% of the time. I've never claimed that technical analysis, or at least my interpretation of it, is perfect. But the day I stop believing in the charts, start to ignore overbought conditions and chase a rally because the general public is chase a rally just for the sake stocks are going up. There are some rallies that should be chased and jumped on, on strong trends. But again, for all the reasons cited in last night's video and other things in recent weeks, that wasn't. And, the big picture, again, I don't want to get too excited from one day as a big down day, but the big picture still, to me, indicates this is probably just a bear market rally. Did it push the upper limits of what previous ones have? Well, most certainly, taking back the 200-day exponential moving average, taking out the 61.8 Fibonacci retracement. We're still below the highs. And I've shared my thoughts on it before. I call this bull market from 2009 to 2020 supersize. That's only the term, at least, that comes to mind for me. And with the big giant bull market, the corrections have been getting larger and larger, increasingly larger. And so therefore, it only stands to reason, you're going to see a very big bear market rally, one of the strongest. Again, that would stand to reason if this is the start of a bear market. And again, not that it matters to anybody, including myself, but I hope it's not the beginning of some, a bear market that takes us much below those recent lows. But right now, we're here to talk about how to, what to trade today and what to trade tomorrow. And some of the takeaways can be maybe how to position for the long term. I think it's even now. I think is a great time for those that weren't able to get out and were praying and hoping when we were down here that things would come back. I think it's a great time to lighten up exposure. Again, if you were losing sleep at night, that's the old saying in the stock market: sell down to the point at which you can sleep at night. And if you didn't do that there, if you were frozen like a deer in the headlights, or you figured you'd get a snapback rally, now even after today, I think it's still objective to diversify, lighten up, make sure you have proper asset allocation. But all right, let's talk about what happened today and what didn't happen. That happened. Sell signal there, rejection at the gap, island cluster top. One thing about the island cluster top, let's talk a little bit about technical analysis and why it works. It's not, magic. It's not solely looking at trend lines and support levels and moving averages. There's a reason why stocks will do certain things, why you can study past price action in similar patterns and then project what's likely to happen in the future. And part of that here, I'm going to turn up these volume at price histogram bars and talk about that a little bit. What happens during an island cluster top. So you can see the volume at price histogram bars on the left show you the amount of volume that traded at a certain price. So you have your regular volume bars down here. Not sure if you can make them out. This is today's bar. This is the biggest bar we've seen in a long time. So high volume today, which is typical on a sell-off. I wouldn't read too much into that, saying, wow, look at the volume of that big red candle. You're not going to have a 5.74% drop in the SPY without a huge surge in volume. It's just what happens. The down days tend to be bigger than the up days. But volume is useful. You can sometimes identify near-term buying climaxes and selling climaxes. Buying climax will come after an extended uptrend when you suddenly have a surge in volume, maybe a single day spike or several days of high volume. But the volume at price histogram, where that's useful, it tells us where people were buying. And just this time frame I've zoomed in here. And my bars are kind of covering because I turned the volume up. Or the brightness up, I should say. We're going back to about May 20th, and I'm on a daily chart right here. And what it tells us is that right here there was a lot of buying, and it makes sense. Remember, we were in about a 2-month trading range for the month of April and May, which we finally broke out of right here and then started moving higher once we broke from that trading range. So it only makes sense you have a lot of volume there. And that was, again, an indecision pattern. It was a period of consolidation. At the time I said that it's likely to determine the next major trend. Break to the upside would be bullish, break to the downside bearish, and that's the way it went right there. So that was the move that came out of it. And that was use the analogy, it's like a coiled spring building energy when you trade within those ranges. You break one way or the other, and that usually determines the next trend. So with that being said, we can see that just recently, let me roll these numbers a little bit bigger. Here we go. Just change the scaling on the price there. Not the scaling, but the differential in price. And it shows you have a big old volume at price histogram bar right here that shows you in this island. This is where the last of the FOMO traders, at least in this short period of time we're talking, relatively recently, just couldn't take it anymore. They had to get a piece of this. There seemed to be a frenzy as the media was reporting, and things I'm hearing. I can tell you in the last week or so, including up to this morning, I was getting texts from phone conversations from friends, even family members, people that don't do this for a living, and they're either wanting to buy stocks, already buying into stocks recently, and so you had a lot of retail traders chasing this rally. And again, that's usually a contrary signal there. When the shoe shine boy starts talking about stocks, that's the time to sell. That's an old thing back from I think it was Joe Kennedy, if I'm not mistaken, passed that along back to the time of the Great Recession. But all right, here you have a big volume price histogram bar, and all I'm trying to say is that means a lot of traders bought up here in the last few days there, and so they're all underwater today. And because of the nature of the gap, see, this is why island cluster tops and gaps can be so powerful, because it serves to trap longs. Let's say you're chasing the rally and you say, okay, you understand prices are high, but how do you make money in the stock market? Buy high and sell higher, right? Chase a trend, and it often works. It worked here, worked here, worked here, and then all of a sudden it stopped working. But what I was getting at is, to control your stops, you would have a stop somewhat below your position. But what a big gap does from where we closed yesterday to the open this morning, we gapped down about 2.5%, and that probably bypassed a lot of people's stops. And if it didn't, I can just tell you that, and I'm speaking generally how a lot of them work. Oh, well, we're down 2.5. I'll just wait till it bounce back and sell. And it got worse and worse and worse. And that's the nature of any kind of rally, especially if this is a bear market rally. This would be just a beautiful way to kick off the next leg down. So that's it. I just want to point out that that's the nature of technical analysis. It shows that people are buying at certain levels, and again, they're underwater, and if we go down more, they become more underwater. All right, so let's just look at levels to watch and what I think is going to happen short term over the next day or so here, and then of course I'll speak to a little bit longer term for swing traders. Okay, I had mentioned on the homepage today, as an active trader, closing out index shorts, reversing to long. I suspect we'll bounce tomorrow. This was, about as bearish as you can get. A big drop like that in the S&P 500, you don't see many of those, even when we're melting down here. So that's powerful. It says a lot. And again, it's not just another arbitrary, down day. It's a pretty powerful sell signal. And like I said, the fact that we had all the indexes, I'll go through those in a minute, the Dow, the S&P 500, all of them triggered comparable sell signals today. And the more indexes that break down, and I think the better defined resistance level or a pattern like the island top is, the more I see it, the more selling you get, the more shorts pile in, the more longs say, oh, that is pretty bearish, I'm going to sell out. So there is that. And I'll just say it. I think this is, means we're probably going lower, considerably lower, and before we go higher. And it very well, as I said, may mark the top. I would put pretty good odds that it does mark the top. We'll see in the next couple of days. I can tell you this is, I think I might have said it in the earlier video today, this is going to be the litmus test, or a true test for the bears and the bulls, to see really what this market's made of. It shrugged off some divergences and other sell signals and bearish candles and all that in the last few months. If they can take this market up and take out the recent highs, in other words, the top of that island, that is going to be nothing but bullish in my opinion. So I can say with a fair degree of confidence that I think any shorts taken recently, including today, if held, and the thing about risk reward now, as I said today, not objective to short in the second half of the day. Certainly this morning when we gapped down, at least a starter position, then you had confirmation right after that video. The NASDAQ Qs took out resist or support. So you had some early clean sell signals, and where we closed the day, we closed right on support. So the fact that we were down almost 6%, coming off a very strong trend, you usually don't waterfall sell-off. Anything is possible, but I put good to very good odds that we bounce tomorrow, and that's why I went long. Despite the fact we didn't get the bounce today in the last hour trading as I thought we might, and I said if we don't, then probably come tomorrow. Why? Well, let's turn off all the let's leave on the levels right there. 302.50. That's a support level I've had on here for a while. Not a super solid support level, but one worth noting. There's some gaps and some other levels. Just a price level I've had on my chart recently. And then you have, as I mentioned earlier, the 200-day simple moving average right here. That's the blue line. And that does, some traders like to watch and trade off the 200-day simple. And not just humans, also algos, computerized trading programs. They'll step in and buy on pullbacks to the moving averages, or sell on rallies into a moving average, just like we had. Let's just go back first with the 200 simple. This is the first tag pullback of that level since we took it out back here. We took it out back here, and we're now back testing it. You can see here, pull back to the 200-day. Here it was the 200-day exponential moving average that held the market. Here you had the simple get hit. There was a brief overshot of the simple. We reversed a little shy of the exponential, the red line. So EMA means exponential moving average. 200 SMA is simple moving average. It's just a calculation. The exponential moving average will track quicker. It will turn quicker and follow prices a little bit quicker because of the exponential calculation, as you can see. So when the market starts going up, 200 SMA, EMA, I'm sorry, tends to turn a little faster and respond a little faster to prices. But they're very similar. And again, the fact that a lot of traders watch them, and it's hard to argue that these are big levels that during bear and bull markets, or even uptrends, traders step in and buy. And on kickbacks to those levels, they often step in and sell. Sometimes you get a 1, 2, 3 day overshoot. So that's that. And as I said, and I'll maintain this. If we drop tomorrow, I think the downside's limited because we have a much stronger support about 2% below, maybe even a little less than where we close. Let me measure it out for you. Grab the bottom of that candle. Right down below where my crosshairs are now, 1.64%. And it wouldn't be unusual to briefly overshoot it intraday and probably close on it. You have the 200-day or exponential moving average. That's the red line. I don't know if you can make it out there. I'll turn it up. You also have the 50-day exponential. I put a bigger weighting on the 200-day, but the 50 is there as well coming in. And so there it is. It's really, another way to say this, there's a confluence of key moving averages which were taken out here. They were tested. See that 200 exponential? Tested, failed. Tested, failed. Tested, took it out, back tested it from above, and then finally walked away after that, and then took out the 200. So that's it, and that's why I think that at this point in time, after the 6% drop today, and remember from the highs a few days ago, we're now down 7%. And at this point in time, like I said, I think the risk reward, despite this is a pretty powerful sell signal, I think in the very near term, the odds for a bounce are pretty good. As I said, favorable, better than 50%. And if we go down a little more, you're talking about 2% or so downside, and then you're going to hit these moving averages and an even a much more solid price resistance level, price support level, I should say. Let me turn off all these lines again. I know this chart looks a little busy, and just show you that level there. It is that multi-month trading range. Remember the month of April and most of May, we traded sideways. I just showed you that a minute ago. You extend that out, and that comes to about 295, I think, is the top of that range. So that's the price support because it was resistance back here. So that's that. A pretty significant amount of support just below prices now. So, okay, Randy, what I do, I didn't short today, or I did short, I want to add on, I'm a swing toward. Again, if you're an active trader, you can try to game the bounce. How much would it be? At least probably 2% is my guess. I like to just, in these cases, trail things up. I'm going to watch futures tonight, and we shouldn't drop much more than 2%. Tricky thing is the futures tend to move overnight. We could drop 3-4% in the futures and then open up in the morning, 8:30 a.m. you get an economic report or something, market starts moving up, and by 9:30 we open up right on that support. So futures can be a little tricky, and in a volatile market, I've learned you just have to give them room. The key to that is just don't take big position sizes. They're leveraged, as you know, if you're trading futures, but don't trade so much that if the futures, or another way to say this, don't trade so much that you can't allow a 3-4% stop loss. If you're trying to trade a volatile market that is now back, volatility has exploded, and we're down, just in the S&P 500 almost 6% today. It's going to be very hard to swing trade something that's leveraged or you have a large position size on if you're only going to give it a 0.5% or 1% stop loss. So that's my key to trade volatile markets. Take down your position size. Unless the charts are very clear and you get on one of these meltdown moments and there's more downside coming, and then you start reeling it in there when you start seeing signs like we did back then of divergences forming on the intraday charts, key support levels coming up on, and that's where you reduce the leverage and then finally move over to a long position. So right now, my scenario, what I think will happen is a bounce tomorrow, whether we gap down in the morning or not. Like I said, minimal downside as long as we recover. If a brief pop below there, as long as we recover it in the first 30 minutes of trading or so. I'm talking about the 295-ish area, those moving averages, price support, and then a bounce. And the big question, I'll be eager to see this, where does it get sold into? So as far as swing trading goes, I would say look at Well, we're going to have some big support down here. We'll probably get a reaction. Eventually come on down here to this bottom of this trading range. And look, I'm still looking for a test and quite likely ultimately a break below those lows right there. Hard to say. I know right now with the economic indicators turning up and all that, it's hard to imagine that happening very soon. But this market is different from every other one out there, and so I'm open to all possibilities. And as I said this morning, if you shorted or you're going to short, maybe on a bounce back tomorrow, maybe we get a 2, 3, 4% kickback rally, and you're looking at the risk reward. You're going to say, well, that island cluster top should hold if that's a topping pattern, so I'll short with a stop not far above 330, 323 there, and the potential. Then I turn to the weekly chart. Really, is what I need to do to look for a swing trade. If you're wondering where I think this thing's going, and my bear market target hasn't changed. I still think we're going down to at some point in 2020 or 2021. Coming down here, the highs back from 2015 to 2016. We came very close back then, but we didn't hit it, and that's a minimum target. And if things get pretty ugly, I could see the possibility of move down here to about 181.66. Some things that give me pause on that too is the Dow already hit that level. The Dow hit that same 2015, 2016 high right here back on the last on that big drop into March. But when I look at this chart, big technical damage done. Long-term trend line, we regained it last month. I talked about this. I'll be turning back. This is a weekly chart, I should say here. We regained it last week, but look, we're back down below there. So there's a little momentum fueled overshoot. And when you take a step back and you look long-term at the entire bull market on the Dow, you take this primary bull market trend line, started here in early 2009, tested it back in 2016, tested again that big drop in late 2018, tested it here, and then boom, fell down, back test. And again, if it wasn't for a lot of factors, including but not limited to the big multi-year divergences that have been building and where we are in the business cycle, everything else, then I might say, maybe that was it. Maybe that bear market's over. But as of now, that's what I'll watch. How do we finish this week? And then very important, I think, and it's a little too early to even talk about it, but how do we finish this month? That's what I'm interested in seeing as well. There's your bull market uptrend line. The Dow, unlike SPY, especially QQQ, there's that big 20-month exponential moving average I love to use for defining bull and bear markets, and not just the last one, going back for decades now. When you're trading below it, you're in a bear market. That was the dot-com bear market right there that started in 2000. First leg down, we back tested the 20-month there, fell down. That's where the bear market ended in late 2002. Followed by a bull market. We were above the 20-month, broke the 20-month here, back tested it, rejected, and then the big drop comes. And that's the scary thing too. If I'm right on this, like I said, I embrace a bear market, love to trade it, but for the sake of the country and everybody else, you don't want to see those. It's not fun. Your neighbor loses their job, your family members, things like that, or at least everyone feels the pain. But that's what I want to mention there, and the trend line break and everything else. So this is just like those previous bear markets, just on a bigger scale. That one it wasn't nearly the size, but you had a breakdown, back test of the trend line, back test of the 20-month, and then boom, the big drop comes. Here you had a breakdown. Oh, there's the primary trend line as well. Breakdown, back test of both the 20-month and the there. So these are things I'm going to watch for this month on the SPY. Like I said, we closed above it slightly. We're pretty much on the 20-month and the trend line on the month of April right there at the end of April. May, we closed above it, fairly above it, not so much. Again, these lines are not... You got to give them a little room. Sometimes you'll trade through there a little bit. They're not perfect, but they do a pretty darn good job. And so what we're looking at is last month, carried us up above there, printed a close above both the 20-month and the trend line. But should we fail this month, then and how we fail, the bigger drop that we have into the end of the month, and the farther we close back down below there, if we do, then that would clearly be bearish. However, if they can rally this up, and as I said earlier, on the daily time frame, if they can shrug off today's bearish candle, recoup all of today's losses, whether it takes a day, a week, 3 weeks, a month, and without going much lower, then that's going to be pretty bullish. And if we print another monthly candle, especially anywhere near the recent highs right here or above, then that's going to clearly have put this trend line in the rearview mirror. So that's what I'm watching as well. And the charts still indicate, this is the last we're looking. This is a monthly time frame here, and you can see, in the past few decades, 3 bear markets. There it is, and that's it. 51%. Back there, roughly 57%. These were little corrections along the way in a supersized market. Even this one, 36%, but to me, more like a correction or the initial leg down in a bear market. And so that's it. That's what we'll be looking for. And there's that target to come in that I was showing you earlier on the weekly, the 2015 and 2016 highs right there. Zoom down a little tighter now on time frames. I jumped all the way from a monthly down to a 60-minute time frame here. And let's look at that real quick and talk about what's happened and where we might go from here. All right, for the last, several weeks, I've talked about these unfilled gaps, and I expected them to be backfilled. I expected this one to be backfilled, and we put in a second one. Then I said, well, I expect both of them to be backfilled now, and we put in a third. And I said, well, now there's 4 gaps, and then a fourth. 4 gaps to backfill. Well, this is what happens when a market, when it pushes, divergences build, overbought condition, bullish sentiment especially. That's why you had such a rush for the exits. And something else I'll cover real quick on those junk stocks, dash for the trash. But again, it just wasn't a random drop. It didn't come out of the blue. We took out the trend line. There's that uptrend line, same one we had on the daily. And like I said, nothing is more bearish than that. Had it just broken down this morning or sometime during the trading day, well, guess what it would have done? It would have allowed a somewhat orderly exit on the longs. They could see the trend line break. Shorts will start piling in. Maybe some will wait till here. But this gap down, I like these gaps, when I'm short, because it traps. And I don't mean to sound callous, but it traps longs in there, and they think, oh, well, I can't sell now, 2.5% down, and it keeps going down, and they can't believe it, 6%. How can this be? The market was bulletproof lately, and so they're waiting for a bounce. So, like I said, I'm looking for a bounce, but nothing too big, and I'll trail stops up. I think, like I said, at least I think 2%, get a 1, maybe even 1% bounce. It could be more, and I'll tell you the levels where it would be objective to short if we get it. I think anything, let me measure out what 2% would look like here. 2% would look about to the bottom, right about, that's almost 2.5 to this gap right here. I don't see solid resistance, but I'm going to put a level there. You have the bottom of the gap and then some price resistance. So I'm going to say 307. That, I believe, would be the first objective level to short or book profits if you're an active trader, or what I like to do too, if it's a powerful trend, we've seen plenty of those lately. If I get to 307, and I have the futures, but I'll look at this too. If I have ES, RTY, and NQ, as we get to 307, we get close enough, and whatever that comparable level is on the futures, put a stop there instead of cashing out, and allow for maybe a run all the way to test the bottom of today's gap. Remember, that's double gap now. You have double gap resistance, gap 1, which has now been backfilled, and gap 2, today's gap. So that's a big level. Let me give you that. And if a bounce back to 307 is a good shorting op, this is even better if we get there. I wouldn't hold my breath for it, but if we got to 312, I cannot promise that shorting there will be successful, or selling your longs that you won't regret it if it goes on through there. But I do think that is a significant level that will be watched by many traders if we get there. And in fact, I wouldn't hold out for the very end of it. I think too many eyes see it. So I think if we get anywhere close, that's probably where we'd reverse, somewhere around there. And the bottom of the gap, technically, if you look at it, zoom in on that candle right there, that last candle where we closed that day, the bottom of the gap's about 311. So that's that. And that's it. 356 was the top of this gap. I put this chart out today, and that's one reason for reversing. So we pretty much close the day on support across the board, not just SPY. I'm going to show you other things that hit support. And as I said, if that support goes, first of all, that's pretty darn bearish. If the buyers don't step in after the big drop today and buy support like that, and we just go lower, I think it's minimal downside. I would put, if I put good to very good odds on a bounce from here, I put excellent odds on a bounce from 295.63. So I would ride that out, and then anything much below that, then there's something else wrong. Something's breaking within the market. Maybe a big financial institution failure, a big bankruptcy that's not foreseen coming, some kind of catalyst. But right now, this was just an overheated, lopsided market. Too many longs, too many bulls, not enough bears, and that's it. So ultimately, I think these gaps get filled, but I think it looks something like this. Boom, boom, and then boom. Next up, QQQ. Again, I would never reverse position. Well, I won't say never. Sometimes I will, but never cover longs and or cover shorts and go long if just one index hits support. Again, it depends on a lot of other factors, but in this case, we had just about everything I was tracking. This is that same trend line I've been highlighting, the blue trend line in the Qs that I said need to break. We had another trend line here, so we hit that trend line right there. So whereas a SPY ended up closing on support and falling toward at the end of the day, so did QQQ, trendline support. Again, big divergences tell me that today's move, as big as it was, a 5% drop, these divergences and everything else is pricing in a much larger drop. So as a swing trader, if you're not a very active trader, I can just tell you what I would do if I put on my less active trading hat, swing trend trading, sit tight, ride out a counter trend bounce, maybe add to a position if I left room to do so on a bounce back to any of those resistance levels. And should QQQ break that line, I have a pretty darn good support level here at 227.80, and I'm going to guess that's probably about the same thing. About if I put the line there, right about 2.5% below. So again, if there's any more downside tomorrow, there's a big gap here that defines that level. Some reactions, lots of reactions. Reaction high here. That line was on the chart before today, and it's still a valid level. And just below that, there's also some gap support. That's the thing about an upturn. There's plenty of support now on the way down to trade off of. And the way it works is, if they just smash through this level like it's not even here, futures tank tonight, we gap down, don't look back. We gap down, take out 227.80. Maybe something else is going on, and maybe that is how the next leg down to the bear market starts. But I think we, at this point in time, especially coming off such healthy and strong price action, it's unlikely that we're going to waterfall sell right away. I think again maybe as much as 2% downside before a bounce. Maybe not. Maybe we'll open up tomorrow and rally from there. And of course, we'll see what the futures do tonight. If they do anything big, I'll do an update. And you can see additional targets on QQQ for swing traders. If and when 227.80 goes with conviction, ideally after a bounce off that level. Remember, we have support levels on the daily chart as well, and some key EMAs or moving averages in general, both simple and exponential you want to watch. But that would be ideal. You bounce, maybe short a back test of this trend line, and then a break of 227.80 should open the door for a move to about the 216 level. Probably get a reaction there because that's a pretty well-defined support level. Hard to say where and if we bounce, and then 203. So near term, those are my targets right there. About 227.80, 216, and 203, give or take on the Qs. QQQ daily chart, remember we took out, this is where we were trading this morning, right on there, right up the open, and said that line needed to go, and it went, and when it went, they all knew it. It was clear. Qs tried to hold it this morning, and then once that level went, support was broken, and there were no other support levels on here for the Qs. That's why you had such a big move. I don't see any price support looking at this daily chart, other than now the next one is this trend line which we closed on, which I just showed you on the 60-minute chart. So that was, again, QQQ at support. If that trend line goes, at least here on the daily chart, I have that about 229 or so. Next support down below, again about 2.5%. Pretty darn good support. So again, from where we closed today, if we happen to open here tomorrow, or if the market was trading right now, I would tell you what I told you earlier today. I don't think it's objective at this point in time to short. If anything else, if you're an active trader, I think it's objective to go long and maybe half a position. Go long again if we drop another 2%, doubled up and to a full position. Full position does not mean your whole portfolio. It just means how much of your portfolio you plan to allocate to this particular trade. Small caps. Price action could not be any more bearish lately. I know there's a lot of lines here, but and I imagine there's probably some subscribers to the site coming in that kind of gave up in the last few weeks. Admittedly, it's been hard trying to call the end of this rally, as we just kept going up, especially once we broke out of the recent trading range. But what I was watching and have been watching before and after we got there is this big 145 level on IWM. A lot of reactions along that level and going back for years. This is a daily chart, and I know this is a busy chart. What I can do is turn off all those lines and draw it out for you. But what happened is we took it out recently. It even acted as support there as well. IWM tried to defend it. Once it couldn't defend it, it gave up the ghost, and we came back to it. Naturally, the first attempt at that, you had a very impulsive rejection. 2 days of selling, pretty big drop. Came at it again, failed once more. Another, failed to get it that day, failed the next day, and finally gapped away. So, bulls. And at the time, I said that's a check mark. Bulls took that level out, but what it has proved to be now, clearly in hindsight, is a false breakout, aka bull trap. That break above that level started to roll over. We came back down, tested it, and that's where we closed yesterday. And as I said, if the large caps were to gap down today, then what that's going to do is take IWM down below that gap, because 145 was former resistance, then becomes support, and we gapped down, and we didn't just gap a little below it or just close a little. We gapped and fell way below it. And we also, in one fell swoop, yesterday we took out the 200-day simple. Today we cleared the 200-day exponential, and you have the 50-day moving average right there right now where we're testing. So like I said, pretty bearish, but when I turn these lines back on, you can see a pretty darn solid support level. We had a big gap right here, and I take that line across. We came up, tested that gap, rejected. Came up, tested several days there, finally cleared it, broke above it. Resistance once broken becomes support. We back tested it for about 3 or 4 days and then started moving away. And so we closed, effectively on that level now, 135.18, close enough. Let me make sure I'm not looking at, no, that's post-market trades. We weren't. Okay, let me turn that off. But that's it. So effectively we closed right on a key support level as well. So that's a common theme today. Down big, especially with IWM. It's down 10% in the last few days, but 10% near-term oversold at support. PPO is turning down. I already mentioned lately we're very overbought on the RSI and indicators, or overbought, I should say. And as I said, and you just have to keep your mind. I'm open to everything. If I'm open to the fact we may go to new highs and well beyond in 2020, 2021, and I may be wrong, but if you're open to the possibility that this was nothing but a bear market rally and just a pretty strong one because all the juice the Fed gave it, if that's the case, then what I often say is overbought in a bear market is a gift. Just like oversold in a bull market, you rarely get to that 30 oversold level. And when you do, in a bull market, you want to step up and buy. Bear markets, what happens, oversold tends to become more oversold, meaning go way down below the 30 level, or stay oversold for an extended period of time. And in bull markets, overbought, you tend to stay up and above that 70 level and either become much more overbought, well above 70, or stay overbought. So what I wanted to say here is we hit it. That's pretty much a kiss of the 70 level. We didn't stay there very long, and only time will tell again if that is what that is. So you just have to be open to the possibility that could have been the end of the run and the best shorting op in that would be in over a decade. It would be better than this one if this is a bear market rally, and we're going to undercut those lows because then we have probably more to fall on the next leg down than we did on the first leg down. That's typically how bear markets work. You get a first wave down, you get a relief rally, and they call it the return to normal phase. Everybody thinks, oh, okay, great, woof, that was close. Market's going to new highs. And then if and as, and this is what you'd want to look for in the coming weeks and months, if and as we can get through here, there's still a lot of support on the way down now. I'm going to say that right now. And I don't expect a waterfall right now. If we do, we'll adjust and adapt. I think, probably at best zigzag our way at first. However, if and when we start to get anywhere close to those lows, that's where usually you'll see or I would expect the selling to begin to accelerate. And there's a reason for that. You start, the people, very few bought here. A little bit more bought here, and a lot more bought here. That's how the retail crowd chases a rally. Even institutional investors, they're far from perfect as well. And so that's what happens. They start getting underwater. Gains turn to losses, or losses continue to build, especially for those that got here, and the selling then starts to accelerate. And so that's something to look for. I don't see that happening right now in the next few weeks. In fact, I see, if anything, nothing else. I see upside tomorrow, either from the get-go out of the gates, or it maybe some point if we can drop 2% tomorrow, hit those key support levels, and then reverse intraday. And whether we close red or green, again, we'll see. Okay, video is getting a little long, so I'll have to just do gold and the dollar and euro and silver in another video. But as I said, dollar had a pretty good move today, and it's well above that trend line now. That might put additional pressure on, especially silver. Gold's catching that flight to safety bit I talked about recently, so I'll update those later. Here's XLK. There's your trend line off the lows right there. There was that alternative trend line. Both were smashed through impulsively today. That is one big red candle. That is a confirmed sell signal. However, we felt a pretty decent support. We had this gap right here and some highs, reaction highs at the top of that gap right there. So right around, let me give you a level. And so we have a sell signal, and not just a very short term, more of an intermediate to longer term sell signal. And some of the biggest question to me is, do we bounce first and then go lower? We're still well above all the big moving averages there. And again, I'm leaning towards the bounce scenario. So, I'd be looking to reposition shorts. If we go a little lower, we still have some support not too far below. But I did want to say that's a pretty good sell signal, the same one I've been waiting for a while, because as I often say, when tech breaks, the market breaks. And tech broke. What I'll do is wrap up here, just running through the fangs. I'll tell you, tech broke. The fangs, yeah, they were down. They're good. You're not going to see the fangs headed up, today. And I'm not going to talk about market breadth. On a day like today, you almost expect almost all stocks down. So it doesn't matter how poor the breadth was. In other words, how many decliners versus advancers. It was plenty, and let's leave it at that. You really look for trends in market breadth, not any one day. On a huge down day like this, again, you're going to see a sea of red when you look at the components, and then Apple and all those will get dragged down with it. So. Yeah, Apple was down, but certainly a big red candle. But we've seen some big red candles along the way. I'm just going to say right now, there's not much or any technical damage done to Apple. It's just day off all-time highs right here. But there is a trend line to watch. There's a big support level below, about 327. So those are the levels I'm watching, and that would again open the door to more selling. That was our previous highs back there. We broke out here to new highs, rallied up. So a break of both the trend line and then 327 right below it. What that would mean is, just like IWM, we'd have a bull trap or a false breakout, and that could really get things going. So that's what I'm watching. But as of now, if you want to look at the bullish scenario, I talk about what could happen with the bearish scenario, but the bullish scenario, say Apple could pull back here. That's probably, I'm going to guess, that same about 2.5% or so, maybe 2. Yeah, right there, about 2% to pull back to backtest the 327 level in that trend line. And so that's what should happen in this market. I think maybe another 2% downside or so if we don't bounce right away. And if we do bounce right away, maybe we then take another jog down next week, hit that level, get a bounce there. So I just want to point out there's some big support levels. And if you are a bull or bullish on the market longer term, and you're looking for where to buy Apple, well, that's one level. And if you're looking for where to put a stop, well, not too far below there. You want to consider that, because much below there, especially a solid close, 2 red candles below, means a false breakout, break of support. No bueno for Apple. Also coming off overbought reading, extreme overbought readings. See, I have different line here. I put a line at about 81 on Apple because 70 doesn't do it for Apple. 70 is considered overbought on the RSI, but every stock you have to treat differently, because some just hang up there. So it's really when Apple hits that 80 levels when you want to start being concerned if you're long, or you want to start getting ready to short it if you're looking to short a pullback. So that's what happened to Apple there. Let me just run through the other fangs. We'll wrap this up. I'll get the video out to you guys. Microsoft, again, big down day, 5.37%, but not anything we haven't seen in this uptrend along the way. There was one right there, and that was, see, this was, to me, a beautiful fake out, a bear trap. We had a nice clean up trend line, well defined, a big red candle there, and Microsoft just chewed it up, spit out the shorts, and from me included in there, I'm sure. Not Microsoft itself, but the indexes. So, that's what's happened, but that doesn't mean it's going to happen again. I'll trade this same kind of breakdown, that same kind of chart pattern, 100 times. And, eight or 10 out of the 100, it's going to burn me. That's what stops are for. But I want to say right now, I was trying to equate this big red candle, that was a breakdown candle. This is not a breakdown. In fact, we're still above the breakout to all-time highs. Oh no, I stand corrected. The highs were right here. So, but I had this resistance level. Let me move it up a little bit right here for you. What I'm trying to do is just tighten up the charts. I'll always adjust my trend lines. I'm not going to stick with the trend line I had if I see prices moving through it. So you can see a lot of reactions. That's what I'm doing here. All these reactions right there, about where we topped right there, and then little candles, and then boom, we popped it, boom, boom. So all we've done today is come to back test this breakout, at least of this level here on Microsoft, and there's also a trend line below. So again, bullish scenario would have these fangs. If the buyers come in and buy up the fangs right here, in fact, I expect it tomorrow. It's how much do they buy it? If they can take out these recent candles, they're going to take this market higher, and that has the potential to undo today's bearish engulfing candle. So what I think will happen is a bounce here soon, tomorrow, maybe no later than next week, but probably come tomorrow, if not in the morning, later in the session, followed by more selling, and this is what I'll be looking. And if you're looking to short the market, if you see the fangs take out these levels that I've covered, I just showed you the level on Apple, I'm showing you Microsoft right here, about 186, 185 or so, solid break below there. These are the things that will most likely open the door to another wave of selling, and probably a more powerful wave of selling. A few more to cover. I need to go back to QQQ to look at my watch list. I did Apple, Amazon, or Apple, Microsoft, and here's Amazon. Again, Amazon is just off an all-time high yesterday. Red candle today. Yeah, there's a doji there. I'm sure there's some. Not coming to mind, some type of reversal pattern, potential topping pattern, and there is negative divergence. Let me not underestimate these divergences. A correction is priced in, but as far as a sell signal right now on a lot of these FANG stocks, no, I don't see sell signals. I see a red day, pretty bad down day. It's because there was broad-based selling in the markets, and I see this one still above support. I have support about 2470, give or take. I have a little trend line there as well. So these are the levels that I think will open up a much bigger drop in Amazon. If that goes, first target zone right there, call it 2250 to about 2186. And again, it would be a pretty powerful sell signal if we get that, along with a breakdown in the other fangs. We don't have it yet. I suspect it'll come, but I can't say with the highest degree of confidence right now. But if that does go, again, I think that opens the door to a much bigger drop. And then I'll start to turn my focus back to these weekly charts, which again are a big part of my longer term view. It's not just looking for a bear market for the sake that we had a big drop a few months ago. It's things that have been priced in the charts for a long time, things that have happened in the economy recently, and so on and so forth. Alphabet, let's jump back to a daily chart. Alphabet took out this trend line recently, but kind of, I didn't mean to do that, hit support here at about 1398. You can see it's danced on support, went a little higher. All we did is simply extend the divergences that were already in place. They're hard to see here. These lines look like they're flattened out, but if I pull it up here, this is the PPO. You can see the negative divergence. You can see the divergence there, pretty much flatlined here on the RSI. And let's that back down so we can see price. So that's it. I just had to extend that divergence line. And red candle today, but closed right on support. So this is a common theme. Indexes closed on support, all of them. A lot of key sectors closed on support. Key stocks closed on support. and so therefore, especially in looking at the recent trend, I think the buyers will step in tomorrow. And if they don't, again, if they go much more than that, then I'll adapt. I will certainly lose on the longs I reversed into today, but I have no problem jumping back in short. But it's gonna take more than a 2% drop from where we're at. Not much more, but a little bit more. And that's it. I think I can wrap up here. Let me just look and see if there's anything else I wanted to cover for you as I draw in these divergences on Facebook that weren't there before. There's your divergence right there. Okay, we'll wrap it up with the futures real quick because I know a lot of you do trade futures. Pretty big support. I had a major reaction high here, big drop. Tried it again, couldn't do it. Little attempt there, finally got above there. We danced around. So I have two support levels in close proximity, about 96.50 we'll call it, and 95.95. That's the one we closed on right there. Big drop down, very oversold in the near term on this 60-minute time frame. So pretty much at support. And like I said, a lot of reactions on that level. Hence the reason, again, favoring a bounce off this level. If we break it, there's, I could add, and I will add. I should add for you some other lines in here. Definitely support right here in the midpoint there, about 93.71. Other than that, I don't have very solid support or decent support till we get down here. But that would be, let me just say, if that breaks, that's the next stop, I think, on NQ. Let me try to measure that out for you. It's probably going to come at about 2.5%, like everything else I was looking on the indexes. Yeah, a little bit more. That's showing, yeah, I didn't do it exactly. Yeah, call it 2.5%. It's not an exact measurement. And then ES. S&P 500 E-minis also at support. Again, same story. Near term oversold. We're not oversold on the daily. The daily took us back to the 50 level on the RSI, I believe, on SPY. And that's usually a level in pullbacks. The 50 level on the RSI will often act as support or resistance when tested from above. But there it is. There's support there, and even a little bit better support there, about 29.77. I'm sorry, that first one was about 3,000. I have 303.55 there to 29.77.65. So, and I imagine that's also going to be about the same thing I told you about. No, not even less than 2%. Only about maybe 1% below on ES. So those are the levels to watch. And last but not least, for you small cap traders, RTY. RTY fell to a very good support. I showed you IWM, a nice support on the daily. Here's the 60-minute chart, RTY futures. That was a big level back here. Bouncing, couldn't break it out. Finally broke out. Never looked back. So we haven't visited it in a while, but again, that's where we fell to. Very oversold near term. There's a downtrend line to watch as well. If you're trading RTY and let's say you go long here, you might want to wait for a break, and my next target would be down there about 1300. But I think we bounce. Where do we bounce? It's not a very clear level, but I'd say about up here 1400 or so. I think is a quite possible near-term target if we can get some traction tomorrow on a rally. I'm going to wrap it up here. If things go the other way tomorrow, I'll focus on some more downside levels. I'll give you my thoughts, but as of now, like I said, it's, even if we drop, it's about risk reward. I think the odds favor a bounce, unless something else is going on fundamentally. I haven't looked at the headlines all day. I've had a very busy day, and maybe there was some fundamental catalyst that kind of caused a technical breakdown in the market. And if it's big enough, then we could see more selling. But all right, you guys know where I stand. Long video. Hope you enjoyed it. This has been Randy Finney with Right Side of the Chart. Have a great evening.